Bank of Canada and the Fed dropped their rates. I talked to a BMO economist, and he says we're going to get 2 more rate drops. All this and more with a good friend and mortgage broker, Mr. Dion Beg, right after this. Here we are, my friends, back with our favorite mortgage broker in all the land, Mr. Dion Beg. How you doing, my man?
Very good, man. Exciting week in the world of mortgages.
Isn't it?
As exciting as mortgages can get, I guess.
Isn't it? Of course, every realtor and every mortgage broker and industry pundit is excited because of a silly announcement yesterday. It shouldn't be the case. And we don't want to overemphasize the excitement. This is, it's just like every other day in the real estate business, my friend.
It is, and you know what? And we've said this before. Lower interest rates means that there's actually oftentimes something negative going on in the economy, and people listening to this might very well know of people who may have been downsized or whose businesses have been impacted with what's been going on in the world of trade and tariffs and all of that. These unemployment numbers of 100,000 people have lost jobs in the last 2 months in Canada, which is huge numbers. And so, yes, we have this lower interest rate, but it's basically on the back of really poor economic data. Yeah.
And whether you're the glass is half full or half empty, there's, as you just kind of said, there's 2 ways to look at this. And there's going to be people that say, oh my gosh, this is still out of whack and that's out of whack. And as you said, unemployment numbers are skyrocketing and everything else, and the sky's falling. And then there's going to be the other side. Interest rates are down. Yes, I've been waiting for this, and this is what's happening. This is the good thing. So there's that balancing act that, our government and everybody else and has to balance, that teeter-totter seesaw effect. And there's always some moving parts.
Yes. And I mean, with the negative that's out there, there are still people out there who are stable in their positions. They're confident that their employment will continue. And in fact, I should just share, there's 2 particular transactions this week that I should share with you. Both of these people are young first-time home buyers buying in the sort of 650 to 800K price ranges. And so they've felt confident enough even before this rate drop to move forward with that transaction. And interestingly, one of them has chosen a fixed rate and one of them has chosen a variable rate. And, they have their reasons for that. For the fixed person, they're like, yeah, we see the rate drop, but we're quite happy locking in something and knowing that it's not going to change for 3 years in their case. And the person who's taking the variable is like, oh, hey, we saw the rate drop yesterday and we were going to do a fixed, but now we'd like to do the variable. Because we do expect that, there might be a couple more rate drops. And I think you were mentioning an economist at BMO who you spoke with this week, Gary?
Yeah, exactly. Yesterday, I had the opportunity to host a meeting and where I got to ask one of the chief economists from BMO what's going on in this world from their perspective, not necessarily his, but from BMO's perspective. Of course, one of the big 6 banks here in Canada. And it shouldn't be no surprise to anybody if you've been playing along and following along. This was kind of his remarks over the half-hour session that I had with him. Is BMO still expecting that the Bank of Canada is going to reduce the rate 2 more times or to another 50 basis points? But that'll probably be 2 steps in their opinion by next March, next spring's market, as well as they feel we're at the bottom of the market, with maybe just a little room to go down ever so slightly. He didn't come out and say, yeah, we are at the bottom, because you just never know until 3 months later, right?
To clarify, when you say bottom of the market, you mean bottom of the price cycle on properties?
Yeah, good clarity. Yeah. Bottom of what's going on, especially here in the GTA and of course in Vancouver. They feel we're almost at that bottom where it's not going to come back up. He was very clear on that. Is going to plateau for quite some time. And in fact, you mentioned getting back to our 2021-22 numbers, real estate numbers here in Canada. He used the phrase, that's the end of the decade. So another 4 or 5 years until we get
I see.
that.
Yeah, and I don't have a graph to share, but I can tell you that oftentimes we're doing refinances for clients. And before we send the appraiser to the property, we'll do a quick snapshot of the neighborhood, and we can get data on that neighborhood and see what's the general direction of that neighborhood. And I can tell you that some neighborhoods are already back on track. So what I mean by that is, let's just say that we've got this steady growth that's been happening. Then 21 and 22, it exploded, and this graph just went straight up. But what's happened is it's come back down, and we're seeing it back on the trend line, meaning that if you just looked at 2019 through to 2025 and expected on average 5% growth a year, or 3 to 5% growth a year, then that's actually what we're seeing again in some of these trend lines right now.
Yeah. And I was going to share a slide that he shared with us yesterday. I don't know if I'm going to do that. And here's the numbers as I quickly look at it, though. Of course, we know Toronto, and then some of the other surprising places. Of course, we know Vancouver, but Kitchener, Hamilton area, those are the ones that are affordability, and we'll call it out of whack. We always know Toronto, Vancouver, the affordability is going to be somewhat out of whack is such a scientific term, but it's going to be on the higher side.
Yeah.
And then of course we've had other cities across Canada, Quebec City being very affordable, Moncton, Calgary, Montreal being affordable. So we are starting to see those big city centers, even as the market kind of levels off, to be somewhat more affordable or favorable for homeowners. Okay, so let's talk about the announcement yesterday. What does it really mean? Bank of Canada cuts rates 25 basis points. What does that mean to the overnight lending rate? What does that mean to my line of credit? What does that mean to me as a borrower?
Yeah, so many of you, when you see these sort of publications or the media, the social media, the interest rate that's out there is now 2.5%, and that is the Bank of Canada overnight rate. Okay, but that doesn't mean that you can borrow money at 2.5%. So I've already had to tell some people, the rate you're seeing is not the rate we get to borrow money at. So put simply, whenever you see the Bank of Canada rate, the actual rate at which you can borrow money, that variable rate, is going to be about 1.5% more than the Bank of Canada rate. So that would be 4%. Okay, so this is actually pretty accurate, in that, as of, say, yesterday morning, before the announcement, we had a lot of interest rates, variable rates at 4.25. Today, those interest rates are at 4.0. Okay, so if you're looking at borrowing variable interest rates today, you're probably looking at around 4%. We actually can get lower than that. I'm giving you sort of a middle of the road number. But yeah, and that 0.25% translates to a little bit of a monthly saving, right? So I think the number we should probably use here is say 500K. So let's say you've got a mortgage at 500K. What you're going to be saving on that monthly payment it's not earth shattering, but it's around $73 a month. Okay. So now with that said, imagine if we do get these 2 follow-up rate drops that your BMO economist mentioned, Gary. So that means that 75, turns into 150, turns into 225 by the spring. So that's a pretty significant saving for those people who want to take that variable rate and maybe write it down, fingers crossed, that it does in fact drop in line with what the economists are predicting.
But and that's the part that you and I need to look at, as from that big picture perspective. Of course, we have transactions, as we all know, week to week, and what's going on today versus that big picture perspective of what's going on in 6 months from now and that type of thing. And one of the things that I love that you do, Dion, with your clients is, okay, this is how it affects you today financially. This is how it's going to affect you in 5 years from now, because this is your long-term growth plan and everything else. Okay, let's talk a little bit about, the Bank of Canada did what they did yesterday. So did our friends to the south of us, the Feds. They did what they did. Do both economies? We all know both economies are obviously attached to each other and how they move, or we're more attached to the U.S. economy. And of course, we all know, and we don't need to rehash how we're trying to move away from that, but we'll still always be attached to the U.S. economy. And when they move rates, what does that do to our economy and our rates?
Yeah. So, long story short is if the Fed moves, it effectively gives us permission to move, right? And we have moved in the face of the Fed not dropping rates over the last year or so. That has happened. But when they drop, it just means that, okay, it's a bit easier for us in Canada to also drop rates, just because our economy is so linked to theirs. And as we've seen on earlier podcasts, the trade is impacting. We are certainly sending out fewer exports, and that's hurting us. But the Bank of Canada technically, and the bank, the Fed governor down there, technically, they're not supposed to make decisions in tandem, but I'm certain that they probably share information and they kind of know what each party's planning on doing in advance.
Yeah. It is interesting to hear that ripple effect, when an announcement is made, we're holding rates, or rates are moving up or moving down, what that does to our local, I'll use it local economies, but our local markets. We've all said this in the past. We don't buy Canadian real estate. We don't buy Toronto real estate. We buy a little pocket in Mississauga or in York Region, like in a little pocket in Newmarket, that type of thing. And that's the market that we need to keep an eye on if you're buying or selling, and of course, investing in real estate. Those are the local markets that we need to keep an eye on for sure. I'm curious. I want to circle back to, you had a couple of discussions you said with some of your clients around fixed and variable rate. Yep. And I've always been curious on this, and I'm kind of throwing this to you in a sense of, would a lender prefer one or the other?
Yeah. So from a lender's perspective, no. It all comes down to qualifying rate. Okay. And so, and depending on where that rate is, it might be harder to qualify for one versus the other. Okay. So sometimes, especially with, say, first-time home buyers who are trying to buy the most home with their finite income, right? We will just ultimately make that decision based on what is the lowest rate in the market at the time. In the last couple of weeks, that rate has by far been the 3-year fixed rate, which we were getting sub 4%. And now we're getting variable rates also below 4%. And so it's kind of like, now we have a choice, right? And so if the 3-year fixed and the 5-year variable are kind of close to each other, it really comes down to a couple of factors. Number one, the borrower's belief in the idea that this variable rate could in fact continue to drop. So that's part of the decision making. Also, in terms of their internal household, what kind of financial trajectory are they on over the next 5 years? Are they likely going to be getting pay increases? Do they know they're going to be working a ton of overtime? And as such, maybe they take that risk of the variable rate. Or if you're on a fixed income, like I've got clients right now, one of whom is on long-term disability. They've got some fixed income there. They're like, Dion, we just can't take any risks. We know the trajectory for variable is down, but we just want to know every month what that payment's going to be. And so we're going to take the fixed. And like I always say, when you lock in your rate, or when you choose your rate, it doesn't serve you to look at it in a year from now and wish that you'd taken the other. Okay. Unless that rate has really dropped a lot. And I will tell you, in fact, we are refinancing people this year who took mortgages about 18 months ago. And the rates have dropped now to such a point that, yes, they'll pay a penalty to break their mortgage, but the saving they're going to get, because rates are so low now, the saving outweighs the penalty. So let's just say, put simply, the penalty is 10 grand, but the saving is 13 grand. So $3,000 saving for just doing a little bit of paperwork. We've got lots of clients who are choosing to do that right now. On top of that dollar for dollar saving, they end up with a much lower monthly payment. So we recently saved somebody around $800 a month in cash flow by doing this type of refinance recently.
That's like an instant after-tax raise. when you can do things like that, right? And this is sometimes what gets lost in these decision making is the money that you're paying out for mortgage is all after tax money. If you can reduce that mortgage payment, that can significantly go much farther.
It's true. In fact, yeah, if you put it that way, Gary, an $800 saving. Let's say your mortgage was $800. To pay $800, you have to earn probably somewhere around $1,500, depending on your tax bracket, right? So the saving is actually significant. An $800 per month saving is like getting a $1,400 per month pay increase.
Yeah, and this is not financial advice from me. And just in my next couple of comments, you can take that $800 and put it into an RSP contribution, and then reduce your financial, your income and get some of those tax benefits. You could donate it into a charity and take advantage of those tax savings as well. There's all sorts of things you can do with it to even help and move you forward. There's all sorts of great conversations.
Well, I'll tell you the most common thing people are doing, Gary, is they're saying, Dion, I can manage that extra $800. It's great that I have it, but I'm now going to use it as a prepayment. I'm going to actually keep my mortgage payment the same so that I end up paying off this mortgage faster. And in some cases, it's 4 or 5 years earlier. And imagine if your payment was $2,500 a month for simplicity. That's $30,000 a year. If you can pay off your mortgage 3 years early, that's $90,000 in payments that you'll never have to make, right? By choosing to make that saving a prepayment.
Yeah. See, these, my friends, these are all conversations you need to be having with Dion and his team. One thing is to get the mortgage. The other thing is, okay, how do we pay it off, or what is the best benefit to you and your family on your monthly payments and that long-term conversation? My friend, how do people get a hold of you?
Yeah, you can reach us at kangamortgage.ca or Instagram at Dion Beg.
There you have it, my friends. That's Dion Beg. Of course, I'm Gary McGowan. We'll see everybody in the next episode. Goodbye for now.